equity mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. I'm excited for this interview. There is a lot going on at the moment in markets. We all know that. And we're lucky enough that we get to speak to experts and try and make sense of it. And we've got a great expert today to help us get our heads around it.
That's it. It's our pleasure, and with great excitement, we welcome Kerry Craig to the studio. Kerry, welcome.
Hi, how are you guys doing today?
We're very well. How are you?
Very good, thank you. I appreciate being called an expert. I don't think I've been called that before.
Well, you're more of an expert than we are. That is absolutely
that's true. It's all relative.
Yeah. So Kerry is a global market strategist at JP Morgan, and before working at JP Morgan, he worked in economic research positions in the New Zealand government and in the UK pension industry. At JP Morgan, he is responsible for offering thought leadership and explaining market data and trends to JP Morgan's investment team and the broader investing community. Thanks to JP Morgan for sponsoring this episode as well. And today we're looking at the state of global markets and what it means for investors.
But before then, Kerry, it's your first time on the show and would love to get to know you a little bit. And we always like to start with the story of someone's first investment. We generally find there's a good story or a good lesson that comes out of it. So to kick us off today, what was the story of your first investment?
My first investment was actually, I think my mother had put some money into like a savings bond or something that I got when I turned 18. It wasn't very much. It was like a few $100s. And I remember it matured, I got the cash, and I decided I was going to invest it in the stock market. And I had been reading about a company in the press that sounded good. They sounded like they were growing. So I basically, this is, way before we did online brokering, and I was living in a small town in New Zealand. Rang up a brokerage and went through and bought some of these stocks. And that company no longer exists. I think that was like the worst investment ever. And my lesson I quickly realized was that I just do not know enough about individual companies to really go in and want to invest on individual stocks. So since then, my philosophy has always been, I'll let other people who know way more about companies do that for me. And I'll focus more broadly on my goals in investing and having the right mix of asset classes to try and achieve that, rather than sort of worrying about, do I own this stock or that stock? Man, I leave that up to the real experts out there to try and figure that out.
Nice.
So, Kerry, you've worked across New Zealand, the UK and Australia. What have been some of the key lessons you've learned, some of the key differences between the markets? Talk us through that.
The one similarity that's very true across all those markets is that people love houses and they have too much of a home bias in their portfolios. So in England, everyone was just thinking about the FTSE 100, and that was the biggest weight in their portfolio, even though it's dominated by financials and energies companies. Similar in Australia, obviously everyone thinks about the ASX 200 and the equity market here. And in New Zealand, it's kind of a mix between New Zealand and Australian stocks. So there's way too much home bias in people's portfolios. And I think that is the biggest mistake, because they overlook so many growth potential opportunities in their portfolio that come from investing offshore. And it's a pretty natural bias to have. Like you want to invest in things that seem familiar, that you recognize, that you see. But I think that's a really good starting point. But if you're really thinking about how to grow a portfolio over time, you really need to look more broadly around the globe for where those opportunities really are going to come for, and just cast the biggest net you can.
The FTSE is a fascinating one. It's an index that I feel like it just never moves. Am I right?
It's a strange one. It's dictated by currencies as much as anything else in terms of how things perform. But again, it's also unusual because it's the UK and where it is right next to Europe, people focus just on the UK and the FTSE, but they sort of ignore what's happening in continental Europe and all the potential there. So it's an unusual one from like a geographical perspective as well, in terms of where the companies generate their revenues. It's not really reflective of the UK economy, which is, I guess, true about many equity markets around the world, but maybe a bit more severe in that case if you want to think about it.
Yeah. I'm also, whenever we get a New Zealand guest on the show, we love to talk about the New Zealand startup scene and the technology companies coming out there, because it just feels like New Zealand punch above their weight. Obviously Xero is the big one, but like Straker Translations, we've had them on the show. They're from New Zealand as well. What's in the water over there? How are you guys, country of 4 million, producing so many good companies?
I think it's just the fact that, I was there a couple of weeks ago to see family for the first time in a very long time, but, you just feel so far away. You go down there and you like literally feel like you're at the bottom of the world. And so I think there's the mentality that you really have to strive and try and do something amazing to really get a global presence and a global stage and to get recognized. And I think there's definitely that mentality in a lot of businesses in New Zealand. They're not thinking, oh, how do I become big in New Zealand? They're thinking, how do I become big around the world? It's just I think it's the geographical isolation and potentially also just that motivation to be more global in nature.
So, Kerry, JP Morgan have just released their guide to the market. Before we get into the nitty gritty, what would be some of the just headline key takeaways?
The biggest themes and the questions we've been getting from clients the last 3 and 6 months, really a few things, like basically where's the bottom in equity markets? Is that coming? Are we there yet when it comes to thinking about inflation and how high bond yields and interest rates are going to go? And the third one is really, how close are we to a recession? Those are the big questions that everyone's grappling with. And if you look at the market on a daily basis, which I would urge you not to do, if you look at the market on a daily basis, it's either inflation's winning and it's going to be too much, or growth's losing and there's not going to be enough of that. And, those are the things that are sort of pushing and pulling on markets at the moment. And you're at that point where there's like not real clarity on which way it's going to go. You got like a really strong inflation number out of the US yesterday. You've had weaker data coming through around many countries. And so it's not clear, which way the market is going to go. And in the background, it's all about, what central banks are going to do in reaction to higher inflation and weaker growth. So it's a really tough time to be an investor and to think about how to position in this environment, because it's quite unusual. We don't have central banks, don't have your back anymore. They're not propping up the markets like they have for the last few years. They're kind of like, you're on your own now. It's back to market forces.
Yeah. So if people aren't familiar with JP Morgan's Guide to the Markets, it's released every quarter. And if people love charts and data, it's their dream. I think it's about 70 slides of every chart you could imagine across all asset classes and all geographies. You said one of the most common questions you're getting from clients is, where's the bottom, or are we at the bottom? And one of the first charts on the in the pack is about the S&P 500 being at an inflection point. Can you talk to us about that? If you can answer, are we at the bottom? That would be great. That would be a real scoop for us on the podcast. But talk to us about, I guess, are we at an inflection point? And I mean, what's to come as much as we can predict an unpredictable market?
Unfortunately, I don't think we're at the bottom just yet. What's been driving equity markets down, or what's been pulling them down, has been valuations. I mean, you can break down the return components of equities into dividends, valuations, earnings, and currency movements, if you're looking at that as well. And what's really been dragging on the outlook or dragging on equity markets this year has been valuations. Like at the start of the year, equity markets, and particularly parts of the equity market like growth stocks in the US, were really expensive because interest rates were low. And now when interest rates start to rise, those valuations don't look so compelling because you're discounting them back at a higher rate. You're thinking about those forward earnings and discounting them back. So they become less worth less now. And then suddenly you're also thinking about the growth outlook being weaker as well. So that's not usually that great for equities. You want higher growth for equities to go up. And that's just dragged valuations down. The equity valuation on the S&P 500 is down 27% through the first 6 months of this year. It's down 30% on the ASX 200 in the first 6 months of this year. That's a big headwind. But now what you haven't seen is earnings expectations really change. So the next sort of downward pressure on the market is really going to be about analysts sort of looking at the growth prospects for the economies around the world, thinking about the revenues that are going to come in, and also thinking about the cost pressures that come from rising input prices, higher wages, commodity prices, and worrying about margin compression as well. So I think that scope for earnings to be downgraded is probably what's going to keep pressure on equity markets, and why it's too soon to say, oh yeah, we've troughed, everything's going to go up from here. That's a very much near-term view. I think the difference is that for a lot of people that we speak to, and again, myself, I'm a long-term investor, and I invest in markets. I'm not thinking about, I'm going to sell next week. I'm thinking about how can I grow my wealth over a number of years. Markets are cheaper than they've been for a very long time, and that's actually very positive for thinking about longer term returns.
Yeah, well, just on that, so the two key points of valuation, what multiple are we willing to pay, and then what the earnings actually are. And we've seen the multiple compress, but we're entering earnings season. In Australia, we're in confession season, where the companies that are about to release poor earnings start to come hat in hand to the market and say, sorry. What are you guys seeing at JP, not just in Australia and New Zealand, but around the world? We've seen what the multiples compress. Are we starting to see earnings look a little bit shaky?
So what we've actually seen is that analysts haven't really changed their earnings expectations too much this year. Maybe that's because they're like everyone else looking for a clear indication of where things are going on inflation and growth. But you haven't seen that big shift in terms of a big drop in earnings expectations. So through the middle of the year, when we look at consensus earnings expectations for the US, they're still around 10%. We would expect it to be 5%, and that's what we think we're going to get for a full calendar year earnings. We can see scope for them to come down. But, we think that if the inflation's still there, if you're still at growth, that means nominal growth is still good. That's actually positive for revenues. Where the pressure comes in is on margins. Those higher costs that are coming through are going to squeeze those margins, and that's going to bring those earnings down. And then you're going to have distortion effects around just a surge in earnings. You're going to have the energy sector, which is also sort of lifting the overall market earnings. And I think if you strip those out, things would actually look a lot weaker as well. But we looked back over history over the last 100 years, and it's pretty rare to get a calendar year where you have both earnings being negative and valuations being negative in terms of a drag on the market. So it doesn't happen that often, and that sort of gives us some sort of scope to think, well, if it did happen, it would be really unusual.
Yeah, right. Wow. Well, it could be quite a historic period we go into.
Could be.
It could be. So, Kerry, you just mentioned there if inflation is still there, and you said at the top one of the second questions your clients come with is, have we seen the peak of inflation? Obviously, there's debate around whether or not we have. We've just seen numbers come out of the US overnight, 9.1%. year on year for June. So what's JP thinking about in terms of inflation? Are we at the top? Where to from here?
It kind of varies by market. Obviously, in Australia, we think inflation's still going to go up at a headline level because of energy prices and food prices and a lagging effect of the housing market on the components of components of inflation, excuse me. So it's likely to keep rising here until the end of the year. And also because we only get it every quarter, it's harder to really judge what's happening. In the US, inflation is probably pretty close to peaks. That was a really strong number that we just came out, over 9%. But if you look at some of the breakdown in the core components, they actually rolled over. So it is about food prices, it is about energy prices, a little bit about housing as well, which is driving those prices up. But those big ticket items, it's caused inflation to surge earlier in the year, like used cars and new car prices, they've come off, right? So some of that transitory stuff that people talked about late last year, it is actually starting to unwind now. It just took a lot longer than expected. And so we would think that those core rates of inflation do start to soften over the course of this year. Headline inflation probably still going to be elevated, but maybe not 9% because of the downshift we're seeing in oil prices, for example. I think the biggest challenge with inflation is that it's going to come down really gradually. And so we are going to have inflation that is higher, and that's going to keep those central banks, wanting to keep tightening the policies and making sure that it's sort of heading back towards those 2% targets because, at 9%, we're some way from it. And so I think that's the difference. It's not just about the peak, it's about where inflation lands.
Yeah, I was listening to a podcast talking about this whole inflation story, and obviously last year everyone was like, inflation is transitory. This year everyone was like, all right, it wasn't transitory, it was structural. But if we zoom out and let's say 20 years from now we're talking again and we say inflation started to rise in April 2021 and it peaked in July 2022, and by the end of 2022 it was back to sort of 2, 3, 4%. In the fullness of time, would probably say, oh, that actually does look quite transitory.
It is temporary or transitory, whatever word you want to apply to it, because by its very nature, inflation is a comparison of prices year on year, so the base effects roll out. But it's also transitory in the fact that it's been successive waves of things that have actually created the inflation. So, you had COVID, the supply disruptions coming out of China because of that, the massive surge in demand for goods as everyone was stuck at home and they was buying things on Amazon, for example. That faded out as we went back to thinking about spending on services, and then you had the reopening, and so that was another transitory impact. And then you've had Omicron come through, you've had China lock up various cities, which has impacted supply chains again, and then unfortunately you've had the war in Ukraine, which has hit commodity prices and food prices as well. So there has been successive waves of transitory factors that have just kept inflation up, but they all will fade. And so you're absolutely right. As we think about the end of this year and into next year, inflation levels will head back to like 4%. But if we think about what that is compared to where we've been in the last decade, where we didn't have enough inflation, it looks very high.
Yeah.
Where does JP think that central banks, particularly the Fed, will take rates sort of by the end of the year? There was commentary overnight that there's chance that they bump it 100 basis points next time they get the chance.
Really?
Yeah.
Oh, wow.
Yeah. So,
It's touch and go, that one.
Yeah. What are your thoughts on that?
We're looking at a target of about 3.5% on a Fed funds rate by the end of the year. Whether they do 100 basis points at the next meeting in a couple of weeks, or they do 75 basis points as the market's really kind of priced in and accepted, if you want to put it that way, and then they do another 75 basis points in September, it's kind of a bit semantics, to be honest, because they get to the same point. It's just how fast they get there. The challenge with doing 100 basis points, and how far they could, because they've said, we're leaving everything open, would be the shock it creates to markets and having to adjust for that, and then sort of really thinking about, well, how high could they go? Because just before the inflation print, the market was very much in line with what the Fed had been saying, where they were going with interest rates, and things become more palatable. It's not just a peak in inflation that we're looking at, it's the peak in central bank hawkishness that they want to become, okay, we're going to start tapering down these rate hikes to 50 basis points, 25 basis points, and the market being comfortable with that. So I think the sticker shock from seeing 100 basis points, which does not happen at all very often, would be something the market would be really difficult to digest. So I think they're probably more likely to go 75 and then maybe sort of push towards another 75 at a further meeting instead of coming down to 50 or something like that.
We're not a property or a housing podcast here, but when we talk about an 100 basis points rise, and I feel like there's a bit of commentary coming out of the US from home builders saying that the market's softening a little bit over there. Like, are they going to see the housing price fall that Australians can only dream about? Well, Australian millennials can only dream about.
Well, it comes back to that point. Everyone loves property. There's a few things we look at when we think about the US economy and the cycle and some of the cyclical sectors, and housing is one of them. It's not like flashing red or anything in terms of the problems there. And you got to remember the way the mortgages work there. You can fix your mortgage for 30 years and not worry about it. So if you've had the opportunity to do that, like in the last 12 months when rates were much lower, you're not really worried about rates going up so much. It's people going into the market. How much price is going to fall really depends on the sort of structural imbalance in the housing market, and there is an undersupply of houses in the US. All that migration that happened out of the cities during COVID into other areas like the Sun Belts, the fact that companies are moving to more tax friendly states or where they think their workers are going to live and they can have access to them, that's created a real demand problem where there's not enough supply. And so those structural imbalances will actually keep prices, at least create a floor to prices in our opinion. It could be an investment opportunity as well if we think about rental income. Is one of the reasons we think that there's probably less risk around a collapse in the housing market in the US more than anything else, else. But coming back to inflation, shelter costs like rents and housing related costs, 30% of the inflation basket in the US. So any weakness there actually translates to lower inflation. And so you do want to see that housing market slow to bring down that inflation. So the Fed will be looking at what's happening in the housing market quite closely, but I don't think it'll collapse by any means.
Yeah.
You see the headlines, Australian housing under pressure, Sydney down 0.1%. It's like,
sometimes New Zealand, Australia just want to be involved. We had houses too, come on. Yeah,
it's like, come on, guys. Tell us something real.
Yeah, it's unbelievable. I think Sydney was down 0.2% from CoreLogic's data, but rents up 9%.
Yeah.
It's just like, can't win.
Yeah. So, Kerry, sort of outside of inflation, I guess, what else are markets pricing in at the moment from JP Morgan's point of view? And I guess more interestingly, what do you think markets are missing at the moment?
Well, it's interesting when you look across asset classes about the recession view. All right. So markets are pricing a recession to different levels. Like you look at the equity market and say, that's really reflecting quite a strong probability of a recession. Or you look at the spread between the 2 and 10-year yields in the US and the fact that it's negative now. And that's an indication of a recession. You look at the credit market, like investment grade credit or high yield, and the spreads have widened a little bit, but not nearly at recession levels. You think, well, they're not worried about recession. So I think what the market is pricing in really varies about which part of the market you look at. But by and large, I think that they're thinking about how close we are to that recession view. And when we look at it, those risks have definitely increased. But I think there's scope to say that, we're not really there on a global recession at all yet when we think about how markets are behaving. And that creates opportunity if you think, well, equity markets have gone too far, so we have upside risk, or if you think, well, credit's actually relatively well priced and we don't think spreads are going to blow out because we don't see that recession. So good income and protection opportunities there. So I think there's that narrative in terms of if you really worry about recession, which part of the markets are reflecting and which parts aren't, and how you take advantage of that. The second thing we think when we look at like what are the risks out there is actually negatively another big energy shock, right? So obviously gas supply to the Eurozone from Russia, they've put in that maintenance period for the Nord Stream 1 pipeline at the moment. There's a fear they don't restart it, right? And that would have a big impact on energy prices in Europe. It would ripple around the world, particularly in Asia, where they tend to move closely. And then there's also the potential that you see further retaliation for sanctions around oil price caps, and you could get a big jump in oil prices again. And I think that energy shock would be something that would be very much tipping you into recession when you're so close to being close to zero. So it's like riding a bike. The slower you go, the easier it is to fall off, and it wouldn't take much of a shock to actually knock you over at the moment. So the big upside risk to inflation, I think, is something not really reflected in markets right now.
Fascinating.
I like the bike analogy. I haven't heard that one before, but it makes a lot of sense.
Yeah.
Most of my analogies don't get cleared by compliance, so you can't say those things.
Love that. Well, they should clear them, that's for sure. So, Kerry, the value of macro forecasts. Now, you're a market strategist, and we've been having a bit of a chat here at Equity Mates over the last sort of week or so, trying to sort of figure out whether or not all the headlines that we see and everything that's going on actually really, deserves the brain space that it sort of consumes when it comes to particularly retail investors. And we're asking the question, is it as bad as people think, or have we reached sort of peak pessimism? So what would be your sort of response to those thought starters?
It comes back to time horizon. I think that, for many people, and that's why it came earlier, I said, if you have the opportunity, don't look at the markets every day, because most people aren't trading on a daily basis. They're not looking at the value of their house every day, for example. They look at it, has it gone up since last year? And it should be the same with your portfolio. So I think when it comes to a lot of these forecasts, just think about your time horizon and what matters for you when you're an investor. And for a lot of us, it's multiple years we're thinking about investing over. And so a lot of that volatility we experience now, a lot of the forecasts that say, we're going to fall into a recession in the next few months, they're less meaningful. In fact, if you look across history in terms of recessions and or bear markets and contractions and expansions in the economy, on average, An expansion is 5 years or more, and on average, contraction or recession is less than 1 year. So they're relatively short periods of time. We think about the market going up in those expansionary periods, and they're kind of the exception to the rule. The second thing I would say about this is that, while the headlines say and macro forecasts might be thinking about a downshift and a recession, a lot of it's to do with like how deep it will be and how long it's going to last and the severity of it. And I think for younger investors out there who are looking, well, I've had all these historical once in a year 100 events in the last couple of years, that can't be right. They're thinking about the depth of the recession from the pandemic, which was very painful and very severe. If you go further back, you look at the GFC, which was this massive systemic shock around the world that came from the subprime crisis in the US. Those were exceptions to how recessions usually look. And so, we might head for a recession. It might be actually very mild. There's few really big structural imbalances in the economies around the world today, which would need to be fixed by a really large recession. And so it could be the case that, we get a recession. It's not that deep, it's not that long, and it doesn't have the same big impact on companies that, everyone's expecting it to. So it's not just about those forecasts that say recessions or where we're headed. It's always about, how deep and long it's going to be as well.
On that point around the there's not that many like structural imbalances. The one thing that I'm really trying to get my head around and I guess sort of reconcile is, on one hand there's negative data and inflation headlines but also the stock market numbers really tell that story. But then on the other hand, the employment market is just ripping along, and like participation rates are at all-time highs, unemployment rates are at all-time lows. There was some data that came out of the US recently that layoff rates are less than 1%. So like there might be some hiring slowdowns, especially in like the tech sector, but in terms of people getting laid off or fired, it's like not really materializing. And I just try and reconcile that information with like the chat in the news around a recession's coming. And I just struggle to put two and two together. So, Kerry, you're the expert. Help me understand it.
Okay, pretty working for that expert title today. It doesn't make sense. It doesn't add up. You don't get a recession without rising unemployment or a material slowdown in employment growth. I mean, that's also part of the stagflation argument. People say, "Oh, heading towards stagflation, too much inflation, not enough growth." The third part of stagflation is actually rising unemployment, and that's what you don't have at the moment. You've got, as you rightly said, record high participation rates here in Australia. You've got almost 2 job openings for every unemployed person in the US at the moment.
Wow.
There's serious demand for people. Some of that's structural, some of it's demographics, older people retiring, people who have retired during COVID as they just wanted to spend more time with family or whatever, so they're moving out. You haven't had the same incentive to come back in, perhaps, again, COVID-related reasons are keeping you out of the labour market. But there's definitely demand out there for workers. And so, again, that sort of lessens the impact of thinking about the recession when you think, well, people are still earning money, and there's a good chance that their wages will go up a little bit because of that demand. There are certain rules out there that central banks have looked at that said if you get a unemployment raise of 0.5 percentage points, so if it goes to above 4 in the US, that would actually be enough for a recession, even though the unemployment rate is still very low. But I think what everyone has looked at over time is that relationship, those historical relationships between the economy and the labour market, or inflation in the labour market, just haven't held up like they expected them to. This Phillips curve, for example, and so they're just questioning how those relationships play through in the past. I mean, technically, in a couple of weeks when we get the GDP numbers out of the US, they could be negative, and technically you'd had a recession because you had a negative first quarter, but it doesn't really feel like a recession when you still have strong labour markets. So it comes back to how you define these things more broadly. So I think the labour market and the strength we're seeing is actually very much a positive for the economies around the world, not just in the US, but here in Australia, over in Europe, they have very low unemployment rates. So it's a very much a point of strength for thinking about how resilient the global economy has been in the face of all these shocks.
So China has obviously been a sort of a pretty big talking point given their aggressive approach to COVID zero, but subsequently it feels like they're just starting to open up a little and I guess change that policy, and that hopefully will have good implications for Australian commodities at least. So what's JP Morgan's view on China's sort of approach at the moment towards COVID and the ongoing impact that's going to have globally?
China's actually, and the broader Asian region, as China reopens, is actually one of our preferences right now. So if we think about where we see growth, it kind of comes back to that point I made earlier around avoiding home bias. China's at a very different point in its cycle than, say, the US. Like, they've had that much later wave of having to deal with the Omicron variant. They're now reopening. It kind of seems like they're coming around the idea to the fact that they're going to have to live with COVID rather than trying to stamp it out completely, but they're not quite there yet. Obviously, you have to think about their vaccines. They've rolled out the vaccination rates among elderly, the pressures that's creating. But it does seem like we could be moving away from those massive citywide lockdowns that you'd want to get away from, and something, maybe more localized. And so that's quite positive for that reopening. And we're seeing it in the data, right? You've seen a lot of retail sales pick up, fixed asset investment pick up. You're seeing people wanting to get out there and spend again. And you're also getting massive support on the policy side. So very low cash rates. They're making it easier for banks to lend. The issuance of local government debt is running at a really accelerated pace compared to prior years. So you get that fiscal spend as well, and credit being pushed into the economy. But they're doing it in quite a managed way because they are worried about the property sector. They're trying to deleverage the economy overall. They don't want the money going to the wrong places. So that's why you're not seeing this big surge in growth. That's why they're doing it in quite a tactical way. It's very positive for thinking about, if you look at the Chinese equity market, valuations are really cheap. There's still some great growth stories in the companies coming out there, and you should see that demand come back through. And that is, as you rightly mentioned, going to have a positive impact on the broader Asian region and APAC, Asia Pacific region. So that demand for commodities coming back through, how it feeds into the external sector and many Asian economies, as well as domestic demand we see coming through there. So it's really much a bright spot for the world when we think about what's happening in the US and Europe. So we have a very favorable take on what's happening in China at the moment. The only caveat to that is that policies and officials haven't really been super clear that they're not going to lock down cities just yet. So I think if those case numbers do start to accelerate from here, and we don't see that city-wide lockdown, that'll be a very positive view for the market. But we haven't really seen just how they're going to treat a new outbreak, and that would be the only thing that really presents a risk at the moment for us.
One thing about China that, there was about a month last year where we all became experts in Chinese property development and, the leverage with Evergrande and its $300 billion in debt. And, they defaulted on some debt. They've been trying to deleverage. But the whole sector is, I guess, overborrowed and overbuilt. We came across some stat in the office earlier this week that there's 90 million empty homes or apartments in China, which is enough to fit the whole country of Germany or the whole country of the UK, which is pretty crazy. How do you think about the opportunity of reopening and the stimulus and what that could mean for the equity markets, while at the same time China is trying to manage this, deleveraging in the property development and the real estate sector?
Yeah, I was just saying it's amazing how quickly we can move from being experts in one topic to the other. I was just getting being an expert in virus mutations, but the property sector, it comes down to like how local governments generate taxes and selling of land to property developers and the incentives that were put in place for them to expand so quickly, as well as the leverage they were using. And obviously, the property sector is very large in terms of the Chinese economy, so it did become a bit of a systemic issue that China is now trying to control. They have eased up on some of those pressures they were putting on the property developers. You have seen credit start to flow. You haven't seen them being necessarily bailed out in a big way, but they're definitely easing back on some of the regulatory pressures coming through. And at the same time, they're making it a bit easier for households to actually, or consumers to actually go out and buy those homes in terms of some of the tax incentives they're putting through. And some of those red lines that they had drawn being removed. So they're definitely easing up on that. I don't think it's going to go away. It's going to take many years to get rid of that leverage and for that sort of stock of houses and demand to balance itself out. But it's in China, they don't think about 1-2 years. They're thinking about they're planning for the economy for 5 years. They're thinking about the longer term. And so the Chinese goal is always to have a sustainable environment for their economy to go in, and they're probably willing to accept a bit of near-term pain to achieve that. And it comes back to that long-term view and the planning they put into the economy, which is quite envious if you think about just how short-term some governments look at their own economy, or how fast politics changes in places like Australia. So I think it will be a case of those target growth rates coming down as they deal with that. But again, the fact they are dealing with it is actually quite positive in thinking about the opportunity in the Chinese equity market, and these big overhangs maybe not being such a risk as they were in the past. So I think there'll be scope for, again, good long-term returns coming out of China, given the valuations in the equity markets have fallen so much.
Now, Kerry, if your compliance team won't let your analogies pass, there's definitely no way that they're going to let you give us some individual stocks. But if we can close the interview, well, at least just before we get to our final three questions, if you're able to at least shed some light on where JP Morgan strategists are seeing opportunities in the market without giving stock specifics, we'd love to hear your thoughts on that.
I think for us, the opportunities kind of yet to present themselves. When you think about how we treat asset allocation right now, it's very balanced. It's very focused on quality. We're looking for those turns to come through. And when it comes down to thinking about like equities and where we see the greatest opportunity, it's going to be on companies that have pricing power and cost control. So as you mentioned earlier, some of the tech stocks are getting rid of staff as they're trying to cut those costs because they're the biggest cost for them. Material and energy companies and some of the industrials have the ability to pass those on. So we're looking at those a little bit more closely. But it's all about operational leverage. So it's really difficult to say by this sector, by value, by growth. It does become much more nuanced than thinking about bottom-up analysis. And where earnings are being where companies are being unfairly penalized given the earnings outlook is actually still pretty good on a 3 or 5 year basis just because of a 1 year view. We actually see better opportunity in credit markets right now. So we'd be looking at the fact that investment grade credit, spreads have widened a little bit, but in the US investment grade space, they're only roughly in line with their average over the 10 years. You're getting quite a good yield pickup over treasuries, and it's a quality asset. It's not something that's going to damage your portfolio. It gives you a bit of ballast, and we'd probably push that into thinking about high yield bonds as well, where again spreads aren't thinking about a recession. You've got really decent yield coming from those again, which is something people always need. And if there is a case of thinking about a recession that's not so deep and not so severe, if it does come, then your default rates aren't going to be as high, and you're actually going to do better there. And moreover, these companies have had really good opportunities to refinance all their debt for many years when interest rates were really low. So they're not really facing this massive wall of maturity that's going to hit them and suddenly think about having to refinance at higher interest rates. So we would definitely focus more on the credit space right now than the equities overall if we're looking for opportunities in the market. But again, in equities, I think that barbell between quality in the US and quality in Australia companies, and then growth in Asia and China, is a really good way to think about a portfolio right now.
Nice, I love that. Well, Kerry, we started the interview by joking that you haven't been called an expert before. I'm confident after this interview you will be called an expert again, because you've shared a lot of great insight with us, and we really appreciate you taking the time. We have almost reached the end of our time, but we do like to finish with the same final three questions. Before we get into them, if people want to read JP Morgan's Guide to the Market for the quarter, or if they want to read more from you or follow you online, is there anywhere in particular they should go?
They can just check out our website. All our information is freely available. We want people to use it. We don't protect it behind firewalls or paywalls, or you don't have to be a financial advisor, for example, to look at it. It's just all there. It's designed for people to use. If you do love charts, as you mentioned, there's plenty to look at. If you're having trouble sleeping, they're always good to have a flip through. If anything, there's probably too much information, but go to the JP Morgan Asset Management website. That's the best place to get all our research and have a look, and it's all freely available up there.
Nice one. Well, we'll get stuck into these final three questions, Kerry. And the first one is, do you have any books that you consider must read?
Weirdly enough, I was thinking about this question. I don't read a lot of financial books. I mean, I think it's from spending all my days reading financial research and looking at markets. I tend to read mainly science books when I'm at home. I did read a legend about the All Black team recently, and I think that's a really good book just to thinking about being in a team and some really good principles to live by. I think if you wanted to look at some materials that would be increasingly important for thinking about the markets today, there is something on our website called the Principles of Long-Term Investing, and they're probably very familiar to people, diversification, thinking about the long run, time horizons, thinking about how dividends and reinvestment really add to that. Those are the principles that really do sit home today and actually going to draw out the best profile for returns, I think, from here on out. So I think that would be something I would definitely urge people to go and look at more than anything else.
Nice one. Love that. And very true to form to get a All Blacks reference in the interview. Now, Kerry, we said...
That's such a cliche. Yeah.
We said, your compliance team isn't going to let you talk about any individual stocks in terms of investment opportunities, but this question isn't about a company as an investment opportunity. This is about a company just based on who it is as a company, its competitive advantage, its quality. So with that caveat in mind, what's the best company you've ever come across?
The biggest company I've ever come across is the one that listens to its customers and its investors. And I can give you an example of a company that I think is quality and makes sense for what's happening today. There's a big issue, obviously, around the world as we think about sustainability and we think about environmental costs of climate change. Food scarcity is up as another big one. And you can take a company like Deere. They an agricultural company. They're really much focused on how they can deliver for their customers and their investors in terms of that environmental aspect, that food quality aspect, and also how they can deliver for return for their investors. And they do that through building technology and AI into their machinery, so they're getting higher crop yields. They're using less water and less fertilizer, which is great for farmers and agricultural producers using the machinery. And they're going to be something that stands out in that sector when they're thinking about what's going to deliver in terms of those longer run investment opportunities. So I think that there's clearly an example of a company that's thinking about their consumers and customers and their investors, and also the broader environment and how they're going to deliver on that. And I think that's a great example of a longer term company that's going to continue to be a standout within that sector. So again, coming back to investment applications, if you can find those companies within sectors around the world, those are the ones that are going to really perform over the long term and actually continue to be okay through these really volatile periods that we're having at the moment.
Yeah, love that. And then final question, Kerry, if you think back to your younger self making that first investment in the New Zealand company that no longer exists, what advice would you give to your younger self?
I would have just, I thought I started early. Like I was 18. I thought that was a pretty good start to get into the markets. But I wish I'd done more. So I did that one and then I kind of left it. I wish I'd actually done more and just kept investing in other things. And, what I do now is what I should have done when I was younger. I continue investing in the markets every month. I don't look at it. I just continue to put money away. I know it'll eventually go up over my time horizon. And I wish I'd started doing that at a much younger stage in terms of just being continued in investing rather than just putting some money in and waiting and hoping something good happened, that I'd just be more involved in the market. So my message to my younger self was be like, don't spend your money on surfboards, go and buy more stocks.
Hindsight's a lovely
thing. Surfboards though, so it's okay.
Well, Kerry, thank you so much for sharing your time with us today. We've taken a lot out of this episode. There's plenty to cover in global markets at the moment, and you've helped us to make some sort of sense of a lot of the big topics. So very much appreciate your time, and again, thank you for JP Morgan for supporting this episode as well. So we look forward to hopefully catching up again at some point in the future.
Thank you very much for having me on today. It was an absolute pleasure.
Thanks, Kerry.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.